Every legendary investor has had their own way of figuring out what to invest in and what to stay away from. In this video, we'll see how 3 of the biggest investors screen potential stocks and calculate their intrinsic value using time-tested formulas. Imagine unlocking the secret to finding a stock's true worth. Let's pick the minds of the biggest investors and take that which will help us make smarter, data-driven investment decisions. First thing, we need to know what intrinsic value is. Simply put, it's the actual worth of a stock based on its fundamentals, not what the market is currently pricing it at. An intrinsic value helps us cut through market noise and assume whether a stock is undervalued or overvalued. Some key benefits of calculating intrinsic value is that you could avoid overpaying for stocks. You can also be able to identify undervalued buying opportunities and overall build a pretty rational investment strategy. Before diving into intrinsic value calculations, let's look at how Warren Buffett, Peter Lynch, and Michael Burry initially screened potential stocks. These legendary investors focus on finding high-quality companies that meet strict criteria. Now, Warren Buffett's screening criteria is net margin has to be at least 20%, gross margin at least 40%. It's got to have pretty good track record of stable and growing earnings. It needs to be preferably above a 15% return on equity, and it's got to have low levels of debt compared to its equity. And it's also got to have a sustainable competitive advantage that protects its profitability over the long term. Now, Buffett emphasizes buying great companies at fair prices, so he's looking for businesses with solid profitability and competitive advantages. Now, looking at Peter Lynch's screening criteria, he's looking at companies with an earnings growth of at least 15 to 30% annually. He's looking at a PEG ratio, or price to earnings growth ratio, of below 1, which indicates undervaluation. Peter Lynch also advocates investing in what you know, so he kind of focuses on industries or products that he understands. He also likes having high levels of insider ownership, which shows confidence in the overall business. He does have a preference for companies that regularly increase their dividends too, so there's that. So Peter Lynch's strategy is all about growth and simplicity. He basically looks for companies with strong growth potential that are easy to understand and not overly complicated. And that's as simple as it is. Now, looking at Michael Burry's screening criteria, he looks for companies with a PE ratio significantly below the market average. He likes focusing on businesses generating substantial free cash flow relative to their valuation. And he also seeks companies with manageable or low levels of debt. He often invests in sectors that are experiencing temporary turmoil or undervaluation. He's also interested in companies trading below their book value or their intrinsic asset value. Now, Michael Burry, known for predicting the 2008 financial crisis, looks for undervalued companies and isn't really afraid to invest in sectors that the market has temporarily abandoned. His risky approach makes him one of the most fascinating investors to study. So once you've identified companies that meet these criteria, it's time to calculate their intrinsic value to ensure you're paying a fair price. So let's get into the formulas. Each method has its strengths and it's suited for different types of companies. And we'll start off with the Benjamin Graham's formula. So Benjamin Graham, also known as the father of value investing, introduced this formula in his 1949 book called The Intelligent Investor. Graham was a mentor to Warren Buffett and emphasized the importance of calculating intrinsic value to avoid overpaying for stocks. His formula has guided investors for over 70 years and remains a cornerstone of value investing. For the formula, we're taking earnings per share, 8.5, which is the PE ratio of a no-growth stock. We're taking 2 times the projected growth rate over the next 7 to 10 years, 4.4, which is the average AAA corporate bond yield, as well as the current AAA corporate bond yield, which is about 5.2 right now. Now, this classic formula is great for quickly estimating a stock's intrinsic value, especially for companies with consistent earnings. So if a company's earnings per share is $5, the growth rate is 6% per year, and the bond yield currently is 5.2%, the intrinsic value using that entire calculation would be around $86.70. Next, we have discounted cash flow. The DCF method traces its roots back to the early 20th century and was further refined in the mid 1900s as financial analysts began emphasizing cash flow over earnings for valuation. It became a widely used method as companies started publishing detailed financial statements, which allowed investors to project future cash flows accurately. Now, free cash flows are actually a lot more accurate than using earnings, so a lot of investors nowadays do prefer the DCF over the Benjamin Graham's formula. Now, for the formula, we're going to take free cash flow, we're taking the growth rate of the cash flow, the discount rate or our desired return rate, and then years of cash flow, and finally our final value of the stock beyond the projection period. The DCF method is one of the most detailed ways to calculate intrinsic value. It's ideal for companies with predictable cash flows. So let's say a company generates $10 million in free cash flow, it's growing 5% annually, and it's got a discount rate of 8%. So using a projection of 5 years, we'd calculate each year's value and sum them up, and the total intrinsic value would come out to be about $350 million. It's important to remember, though, that if you want to break it out by share, then you have to divide this by the shares outstanding or run the calculation by the free cash flow per share to get the intrinsic value for one share. Next, we've got the dividend discount model. The DDM was developed in the 1930s as part of early financial theory. It was formalized through the work of economists like John Burr Williams in his 1938 book, The Theory of Investment Value. The DDM has been instrumental in valuing dividend-paying companies for nearly a century. For the formula, it's quite simple. We've got our expected annual dividend per share and our required return rate and the dividend growth rate. This method works best for companies that consistently pay dividends, like utilities or dividend aristocrats. So if a stock pays $3 in dividends annually, we've got a 3% growth rate, and we've got a required return of 7%, the intrinsic value would be around $75 per share. All right, method 4, the price to earnings growth ratio. So the PEG ratio gained popularity in the late 20th century as analysts sought to enhance the traditional price to earnings ratio. By incorporating growth rates, the PEG ratio became a more nuanced tool for evaluating growth companies. While not as old as the other methods, it has been a valuable tool for investors over the past few decades. For the formula, just as simple as the DDM, we've got our price to earnings ratio, and then we've got our growth rate. While it's not a direct intrinsic value calculation, the PEG ratio is useful for comparing companies. So a PEG below 1 often indicates undervaluation. So a company with a PE ratio of 15 and a growth rate of 10% would have a PEG ratio of 1.5. While this isn't undervalued, it's worth comparing with peers. So which is the right method for you? Well, it depends on the company. For the consistent growers, you've got the Graham's formula that works well for that. For the cash flow heavy businesses, DCF is ideal. For the dividend paying companies, DDM suits that. And then the PEG ratio can be used for quick comparisons. Calculating intrinsic value is key to making smarter investment decisions. Each formula has its place, so use them wisely based on the company you're analyzing. Let me know in the comments what your favorite stock is right now and a calculation method you'd use, and I'll try to respond and see if I can calculate the intrinsic value. Anyways, thank you guys for stopping by, liking the video, and subscribing to the channel. As always, I'll see you in the next one.